Have you fed up failing funding challenges over and over again? There are usually two reasons why that happens. Either you approach funding challenges with a gambling mindset without solid plan, or your strategy is not suitable for those challenges' rules. If it's the latter, this video may have a solution for you. We will test a mechanical strategy that according to its creators promises to get you funded provided you follow the rules, and it will do that spending very little time on the charts. I will backtest this strategy to see how it performs and see if it actually can keep its promise to get you funded. The strategy we will test is called the Power of Two. And before we begin, full disclaimer, I have no affiliation with the creators of this strategy, a fellow trader suggested to try it out, and I decided to look it up as part of my experimental journey. The creators of this strategy is a group called Evolution Markets, and I learned details about it from one of the creators, Scott Taylor FX. You can find more information about the strategy in his YouTube channel as well as podcast interviews he has done. This strategy utilizes concepts like kill zones and premium and discount zones, which we will dive into later. According to Scott, they trade two pairs, EURUSD and JBP-USD. For this video I will backtest EURUSD. They trade two sessions, London from 8 to 10 GMT and New York from 1:30 to 3:30 GMT. Those hours is what they refer to as kill zones. They use two indicators in TradingView, fractals and sessions. Fractals to point out the fractals, and sessions is just to mark the kill zones where you trade in. They use two time frames, the 4-hour to identify the daily bias and the 15-minute to find entries. And finally, there is only one entry model with 1 to 3 risk to reward. I have used this table before in other videos which shows the correlation between risk to reward and win rate. As you can see here, with 1 to 3 risk to reward, the strategy needs to have at least 25% win rate in order to be break even. Anything above 25% is profitable. The benefits of this strategy is the set and forget principle, which means once you analyze the charts, you set an alarm for the price points of interest and then you wait for the entry signals. Once you enter the trade, it will either hit your take profit or stop loss. So there is no management there, hence you don't need to be on the charts and you move to the next trade. Another benefit is that the system has specific criteria, which means it leaves little to no room for discretion. It will either meet your requirements for entry or not. Because of the strategy attributes and how mechanical it is, once you backtest it enough and have the data how it performs, the creator suggests that it's simple after that to get funded to a prop firm with being only a couple of hours in the chart daily, provided of course that you follow the same rules that you did on the backtest. I will point out here that a major disadvantage of any mechanical strategy is that its performance is highly dependent on the market cycle because of the lack of flexibility it has to its rules. What that means is that mechanical strategies tend to perform very well in certain conditions and not so well in others, and you will find out how well or not performs in certain period after it's passed from the result. On the other hand, with discretionary strategies you can be more flexible and adjust quicker to the market changes. Nevertheless, that doesn't mean that those type of strategies do not work or don't perform well. After all, that's why we backtest for as long as we do. So, let's put it on the test. As I said, I will backtest EURUSD starting from January 2023 until June. This is 6 months of data. The tools that we need are TradingView to do the backtest and also the two indicators for the strategy, fractals and sessions, which you can find from the indicator tab. We will also need a 50% Fibonacci retracement to identify the premium and the discount zone. I will also need a spreadsheet to journal the trades from Google Sheets. If you want this journal spreadsheet that I'm using, I will leave a link in the description to download a copy. We open the EURUSD chart in TradingView and load the indicators, fractals and sessions. We open the fractal indicator settings and I will change the colors of the arrows just for aesthetic reasons. You can choose whatever you want. And I will also remove the zigzag options to avoid cluttering the chart. Then we will open the session indicator, remove the Asian session since we only need to mark the London and the New York session, and I will put the 2-hour skill zone at London open and the 2-hour skill zone in New York session starting 1 hour before New York Stock Exchange open. And remember the time zone difference to where you live. For example, where I live is GMT +2. Once we have the indicators loaded and set, we load the 4-hour time frame and we mark with a line the most recent high and low fractal. Now, this is where it gets a little technical, so pay attention because we will try to identify the daily bias. There are 2 bullish scenarios, 2 bearish scenarios, and 2 counter trend scenarios, and they go like this. If the 4-hour high fractal is broken and 2 4-hour candles in a row have closed above, then we have a bullish follow-through. In that case, we wait a retracement to the discount zone to look for buys. If one 4-hour candle breaks the low of the previous fractal low and close above, or even if it closed below and the next 4-hour close bullish, then we have a no follow-through and we look for buys from discount zone. If the 4-hour fractal low is broken and 2 4-hour candles close bearish in a row, then we have a bearish follow-through and we wait for a retracement to the premium zone to take sales. If one 4-hour candle breaks the high of the previous 4-hour fractal but close below or the next 4-hour close bearish, then we have no follow-through and we look for sales from premium zone. Once we have the direction bias and the range of the 4-hour, we pull a 50% Fibonacci tool so we can identify the premium and the discount zones. If we have a follow-through, either bullish or bearish, we can look for a counter trend position if all the other criteria for entries are met. That means for a bullish follow-through, we are looking to sell from premium towards discount zone, and for a bearish follow-through, we are looking to buy from discount to premium. Once we form our bias, we zoom in the 15 minutes to check for entry signals. Once we are on the 15-minute time frame, we mark the most recent highest or lowest fractal and we create a box. Once we have a 15-minute candle sweep the fractal low within the kill zone, after that candle closes, we set a buy stop at the high of that candle, stop loss at the bottom of the wick, plus a couple of more pips for safety, and the take profit 3 times the stop loss pip amount. Once we have a 15-minute candle sweep the fractal high within the kill zone, we set a sell stop after that candle close at the break of the wick of that candle, and we set the stop loss on the top of the wick, plus we give it a couple of more pips breathing room, and we set our take profit 3 times that distance. The only reason not to take a trade is if there is a signal and the take profit is out of this 4-hour range, high or low. I will start now the backtesting and get back to you with the results. And that was it, traders. As you see, the results of this strategy are not as impressive as your average guru promises, but if you consider how little time you need to analyze, mark your charts, and once you get an entry signal, basically you set and forget the trade, as well as the consistency of the results, which is in the positives, I believe it's worth to give it a try. If you enjoyed this video, consider to leave a like, and why not share it with a fellow trader who you think it might help. As always, I would suggest that you backtest the strategy and see what kind of results you will get. And one more thing before we wrap it up. Remember that the results of backtesting this or any strategy tends to be higher from live conditions. That is because when we backtest, we have perfect conditions, we test months worth of data within a couple of hours, and that also led us to be more focused into a good flow status. Of course, that's not realistic on the day-to-day life that everyone has. So always take this in consideration when you're going to live. Deviations will happen. For example, I used this strategy in the month of October and November, and I had a total of 11 signals so far, which 9 of them were losses and 2 were wins. That's a total of minus 3%, if you consider that I'm taking 1% risk per trade. But I missed both of the wins because I was occupied with live matters. So I sit in a total of 9% drawdown. And that's also what I mentioned earlier for the mechanical systems and how they perform within the market cycles. Nevertheless, the backtest data are here to support the longevity of the strategy, so I will keep using this strategy and see the results and how it will perform in a larger time period, 1 year and even more. Thank you very much for watching this video, and I will see you to the next one.